1. Introduction. Why impatience is an investor's greatest enemy. In financial markets, impatience is not just a personality trait, it is a psychological trap with direct financial consequences. The scientific and empirical foundation of long-term investing often clashes with the desire for quick gains through short-term decisions. Impatient investors tend to overreact to market fluctuations, leading to poorly timed sales, premature profit-taking, or unplanned increases in trading activity. 2. The impact of psychology on investment decisions. Investor psychology establishes a direct connection between behavioral finance principles and market outcomes. People often act on emotional reactions rather than rational decisions. Loss aversion and myopic loss aversion. The human brain feels losses much more intensely than gains. The pain of losing 1 unit is approximately 2 to 3 times stronger than the pleasure of gaining 1 unit. This leads to rushed and panic-driven decisions aimed at avoiding losses. Disposition effect. Investors tend to sell winning assets too early, while holding losing positions for too long. This behavior, driven by the desire to avoid psychological pain, negatively impacts long-term portfolio performance. Illusion of control. Investors often believe they can control the market. They constantly monitor prices and frequently adjust positions. However, financial markets are complex and influenced by numerous external factors. This need for control often harms performance rather than improving it. 3. Direct consequences of impatience. Overtrading and increased costs. Impatient investors tend to trade frequently in response to market fluctuations. Overtrading increases transaction costs, reduces long-term compound returns, misapplies the idea of profiting from price movements. This behavior is especially common in stocks and highly volatile instruments, such as foreign exchange and cryptocurrencies. Overreaction to market noise. Short-term price movements, news headlines, social media signals, and emotional stress push impatient investors to react quickly. Instead of following a strategy, they make impulsive decisions, frequently opening or closing positions based on temporary price changes. 4. Scientific and financial perspective. Why impatient investors lose. A. Myopic loss aversion. Behavioral finance research shows that focusing on short-term fluctuations reduces overall portfolio performance. Constantly monitoring prices distorts risk perception and increases panic-driven decisions. B. Emotional reactions, fear of loss and over-optimism. Investors often panic sell to escape losses or become overly optimistic in pursuit of quick profits. Both behaviors damage long-term strategies. C. Behavioral biases. Herd behavior, overconfidence, framing effects, and the illusion of control push investors toward short-term thinking and emotionally driven decisions rather than data-based analysis. 5. The advantages of patient investing, from theory to practice. Compounding returns. Over time, reinvesting gains leads to exponential growth. Patient investors benefit significantly from compounding. As Warren Buffett famously suggests, the stock market transfers money from the impatient to the patient. Emotional stability during volatility. Well-structured portfolios withstand short-term volatility better because disciplined investors stick to their plans. Avoiding panic selling and not prematurely realizing losses is often more effective for long-term risk management. 6. Practical advice. How to control impatience. 1. Define a strategy and stick to it. Before investing, establish clear short and long-term goals. Your risk tolerance, entry, exit, and reinvestment rules. A defined strategy reduces emotional decision-making. 2. Replace daily monitoring with weekly or monthly reviews. Daily price movements increase anxiety. Setting structured review intervals helps reduce emotional reactions. 3. Keep an investment journal. Recording the reasons behind each entry and exit helps identify impulsive behavior and correct short-term, aggressive tendencies. 7. Conclusion. Patience is an investment tool. Impatient investors lose not because of the market's volatility, but because they fight their own emotions. When science, psychology, and financial theory align, They show that patience is not passive waiting, it is strategic discipline. Patience enhances long-term compounding, reduces costs, and limits emotional decisions. Impatience, on the other hand, disrupts rational decision-making and becomes one of the most costly mistakes an investor can make.